Hey everyone, welcome to another case study breakdown of where we help you control where your money goes. So in this video, we'll be discussing Jose from Brazil, who provides B2B services for North American companies. Jose is a Brazilian citizen living in Brazil with his family. He currently does not have plans to relocate, at least not until his children are in school, but he needs assistance with restructuring his business. He is a shareholder and director of 3 companies. One is his own company in the US, which does not have any operations. In reality, he just established it to have access to a bank account for risk mitigation and aims to use it for transferring dividends and salary from other companies. As it has no operations in the US, the projected taxes to be paid here are $0. The Costa Rican company has been incorporated for several years but has never paid taxes there due to the territorial tax concept, even though they fully reported their revenue. The amount to pay has always been $0. However, the US-based company is new and they will be feeling taxes for the first time this year. Now, the employees that he has are located all over the world, including Argentina, Japan, France, Poland, Turkey, Brazil, and Costa Rica. And their clients are companies located in the US and Canada, and they all pay a flat fee every month. The clients purchase their service online and pay with a wire transfer. The concept is that all the old clients with contracts with the Costa Rican company pay for the service to that company, and then the new clients they onboard have contracts with the US company and pay to that company. The main reason for shifting from Costa Rica to the US company is that they feel much safer banking in the US than in Costa Rica. So what's the flow of money right now? At the moment, most of the money goes into the Costa Rican company, which then transfers it to a US LLC. They then use the US LLC to pay for most of the expenses, including the offices of all the companies. Now, Jose receives a salary and dividends from the Costa Rican company, which he intends to send to a company in the US that he owns 100%. Now, what does Jose want? Jose is particularly interested in the following. Firstly, business tax optimization. The goal here is to establish a comprehensive, transparent, and effective international legal structure tailored to his circumstances, business goals, and future endeavors. Now, secondly, personal tax optimization. Despite the challenges with tax enforcement in Brazil, it's important to plan for the future and to ensure more freedom and security for himself and his family. And finally, there's asset protection, to safeguard for his family and invest his wealth efficiently. Now, before we go into possible solutions for Jose's new structure, we'll go over the weaknesses of his current structure. In the current structure, most of the money goes into the Costa Rican company. Then, since there's more trust in the US banking, that company then transfers the money to the US LLC. Now, the problem here is that there is no legal basis to justify that transfer. The LLC pays almost all the expenses. It pays for offices, but it also pays for contractors and other expenses. There might be a better way here to organize expenses and do banking. Now, another major weakness relates to Jose's new company, the LLC, which was established last year in the US. It was originally set up to provide access to a US bank account and transfer his dividends and salary from the company in Costa Rica. Now, sending his personal income without any legal basis to another company is very questionable. Now, it would be different if that US LLC held shares of the company in Costa Rica so as to receive dividends instead of Jose personally. The same applies to his salary. His salary is paid for the work provided to the company. That is what he personally earns, and that payment should go to his personal bank account, not to a bank account of another company. The difference could be made if his LLC were engaged to provide some work for the companies, with Jose doing that work on behalf of the company. Now, Jose obtained a Brazilian tax identification number about 2 years ago and filed his taxes for 2020 and 2021. He never filed everything, but reported the small amounts of money that he transferred to his Brazilian accounts. Now, this is one of our main concerns. As a tax resident in Brazil, Jose is liable to tax on his worldwide income and assets, including his salary and dividends received from a Costa Rican company, even if he did not bring them to Brazil. So what is the proposed solution here? Transferring money from a Costa Rican company to a US company. Now, for the first topic of transferring money from the Costa Rican company to a US company, the best way to transfer money from a company in Costa Rica to one in the US, while having a legal basis to justify that transfer, is to put shares of the Costa Rican company in the US company so that it wholly owns it. That way, a company in the US can receive the money as dividends without legal issues. Now, to prevent any bank issues, we recommend Jose set up a second bank account outside of Costa Rica and flow money through that account. It will be much safer not to have money flow through Costa Rica. Jose and his partners feel safe about US banking, so we recommend one of the Puerto Rican-based banks. It can take some shopping around before finding a bank that meets their business needs, but in the end we are able to help speed this along with some recommendations. Now, if we assume that the money was transferred from the Costa Rican company to a company in the US, and that we need to transfer Jose's share of the dividends from the US company to his US LLCs, there are 2 possible options to build this into the structure. The first option is to convert Jose's US LLC into a holding company, which will hold his shares in a US company instead of him personally. The second option is to have a US company pay his US LLC for services rendered. In other words, the company can pay Jose in one of two ways: fees for services or dividends. Which option would be better depends on the final structure from Jose's personal side. So both ways are possible and have advantages. Paying a fee for services requires creating services that Jose's company will perform for a fee, but Jose would be able to retain ownership of the company. Jose would only hold 49% of shared companies, so it would not trigger Brazilian CFC rules or any transfer pricing issues. Now, paying out as a dividend would be less of a hassle, but in that case, Jose would have to transfer his share of the US company to his LLC, which would then be held by a trust or foundation, so he would have no ownership, even though he would actually be the one controlling it. Now, following this route and placing the US LLC into the trust or foundation. Now, the CFC issue relates to Jose's LLC in the US. If Jose were to remain the sole owner of his LLC and receive dividends, which are passive income, he would trigger the CFC rules in Brazil. So it would be better to be held by a trust or foundation. If he would still like to keep a part of his LLC, that will be possible because he could remain the owner of 49% of the LLC and 51% can be placed in the trust of the foundation. A trust or foundation is not only a good tax planning tool, but it is also an estate and inheritance planning tool. So Jose may ultimately want to put all of the shares of his US LLC into a trust or foundation and continue to manage it. Now, the main question here is to consider whether to place Jose's LLC shares in a trust or a foundation. Both are possible options, but forming and maintaining a trust can be quite costly. So we usually recommend forming such a trust once there is at least $1 million in liquid assets. Therefore, it would be more cost effective for Jose to set up a foundation. In this case, we would recommend that Jose form a Panamanian foundation. A Panama private interest foundation is exempt from income taxes provided that no residents of Panama benefit from the foundation and no physical assets held in the foundation are located in Panama. The foundation cannot be used for commercial purposes, but it can hold shares in a company that itself is engaged in a commercial activity. Now, just for quick info, a foundation is a non-profit organization generally established to reflect the wishes of the founder through an endowment of assets managed by council members for a specific purpose and or for the benefit of its beneficiaries. Now, Jose can have a nominee founder who will form the foundation and put the shares of his LLC in it. The main question is what Jose's role will be. If he is a member of the council, there is a threat of management and control rules in Brazil. Now, if he is a protector and appoints a nominee council member, that can result in very high maintenance costs. Now, we assume that Jose wants to run the foundation and remain a member of the council, in which case he can appoint 2 more trusted people, perhaps some family members. Since the rules of management and control are a matter of fact, not form, realistically, we will have a nominee council, but all the decisions will be made by Jose, so realistically, he'll be the one actually managing it, and the management control rules could apply, but another question is whether anyone in Brazil is ever going to check that. Likely not. Now, Jose plans to invest in the coming years, so when his assets reach a certain level, he can add more people to the structure to improve and strengthen it. Now, in addition to determining his role in the foundation, it is also important to clarify when the distribution from the foundation to its beneficiaries should be made. Considering that Jose's children or wife are likely to be the beneficiaries and will be taxed on any distribution in Brazil, it is advisable to hold off on the distribution until they become tax residents in a more favorable jurisdiction. Alternatively, they can take advantage of deferral and reinvest the funds until they need the money. So the overall strategy is as follows. Number 1, transfer the shares of the Costa Rican company to the US company. 2, transfer Jose's share of the US company to his US LLC, or establish a fee-for-service agreement. 3, establish the Panama Foundation. 4, transfer the shares of Jose's LLC to the Panamanian Foundation. And 5, set up the bank accounts to actually operationalize all of this. Now, what's the benefit of this whole shift? Let's start with the original state. If Jose maintains the current structure, he'll be subject to taxation in Brazil on his worldwide income, including his salary and dividends received from the company in Costa Rica. Additional management and control rules and CFC rules may apply to his companies, resulting in a 34% tax rate in Brazil. Now, the profit of the Costa Rican company was $700,000, and if Brazilian tax rules were applied, it would result in $128,000 in taxes. In addition, Jose receives an average salary of $200,000, and the Brazilian tax rate on that amount is 27.5%, resulting in $55,000 in taxes. Now, this brings the total tax amount to almost $183,000, so that's a lot in taxes per year. Now, what's the new state? The proposed structure offers substantial benefits. Not only will it align Jose's business with business regulations, but it will also help him achieve his goal of protecting his assets. The total tax savings will depend on Jose's lifestyle, his ability to reduce living expenses, and whether he can opt for a lower salary, perhaps $100,000 instead of $200,000 annually. However, let's assume he prefers to maintain his current lifestyle and salary and is willing to pay the taxes on it. In this scenario, we can save on the amount he receives as dividends. If that amount is transferred to a foundation and retained there for his family, it will not be taxed as long as the income remains within the foundation or the company held by the foundation. Now, Jose can take advantage of this opportunity to reinvest that money and continue to grow it without incurring taxes. Therefore, the minimum annual savings would be at least $128,000. Over a period of 10 years, this would amount to $1.28 million. Now, if his family, as beneficiaries, decide to receive income from the foundation at some point in the future, they will be taxed at the Brazilian tax rate if they are still residents of Brazil. So ideally, they should become tax residents of a country with zero tax before receiving the distribution, so they won't have to pay high taxes in Brazil. This relocation doesn't need to be permanent, it could just be for a couple of years until they get the money from the foundation. Even if they remain Brazilian tax residents and have to pay Brazilian tax when they receive the distribution, they will still benefit from deferral. In general, the benefits of deferral are significant. Now let's just do a quick tax deferral lesson, explaining the benefits of tax deferral. To illustrate just how significant this is, we'll use some fictitious and somewhat exaggerated math. Imagine you started with $1, and each period you doubled this $1, so at the end of the first period you had $2, and then $4, and then $8, and so on. At the end of 20 periods, you'd have $1,048,576. By contrast, imagine if instead of doubling after each period, you were taxed at a rate of 33%. So, $1 doubles, and then the extra $1 raised is taxed at 33%, leaving you with $1.67, which then doubles again, but the $1.67 you added gets taxed at 33% again, and so on and so forth. If in the first scenario you'd have over $1 million at the end of 20 periods, how much would you have after the same 20 periods in the scenario net of tax? It would be reasonable to guess something around 670,000, right? So that's 1 million minus 33%, right? But in fact, the answer is much lower due to the power of compounding, or in this case, negative compounding. The answer is actually $28,466. Over $1 million less than you'd have in the first scenario. So this is a huge effect of tax deferral. So even if you let the money grow till the end tax deferred and you then paid 33% tax at the end of the first scenario, you'd have nearly 25 times more money in the tax deferred scenario than in the taxable scenario. These numbers of course are not believable because no one is going to double their money each period and no one will start with only $1. But this is just showing that the faster you compound the money, the more impact the powers of deferral will have. So here I just created a small illustration so you don't have to do the math yourself of what deferral means across different growth stages. So firstly, we have growing 100%. This was our original scenario. Obviously, it's very exaggerated, doesn't really make much sense. So next, we have growing at 9%. This is based on the average of the last 50 years of the MSCI World ETF. So from December 1969 to March 2024. This is what's seen as one of the most boring investments possible, just investing in global stocks. Super brain dead, everyone can do it. And even growing with this 9%, you can see here the difference after 20 periods, or in this case, after 20 years. The amount with deferral will become $5.60. So if you take that as 100%, the amount you earn without deferral is $3.23. So only 58% of the amount you would have earned with deferral. Now, if we were to go beyond the super boring 9%, let's say you have maybe some private investments or you're particularly good at investing, you might be working with figures such as 15% or 20% growth year over year. Then as the growth rate increases, the exponential effect of deferral becomes a lot bigger. So on 15% growth rate, being without deferral leaves you with only 41% of what you could have achieved. And for growing at 20%, you only earn 32% of what you could have achieved if you had deferral. So this is just a quick illustration of what it means to have tax deferral and the power of it. Now then, back to Jose from Brazil. So what's the benefit of this whole shift in terms of final cost versus benefit? So in the end, the costs of setting up the structure are not high either. The costs are mainly connected to setting up the foundation, so the overall cost should not exceed $10,000. Let's look at this from before after. Before, they would have been paying $183,000 in taxes per year. Now afterwards, this amount is reduced to $55,000, assuming Jose maintains his current salary and lifestyle and doesn't want to reduce it. So that's a minimum tax savings of $128,000 per per year, plus a deferral on the $700,000 profit that is invested. So over a 10-year horizon, the immediate savings are $1.28 million, plus deferral on the $7 million profit that is invested, which could grow up to $12.3 million, assuming a 9% return on investment, assuming we base it on global boring ETFs. Now, all these additional savings only cost $10,000 to set up with. This is again a perfect example of what you can achieve if you have more control over your money with smart legal planning as an entrepreneur. I hope you enjoyed this case study breakdown. Feel free to scroll along to our other case studies if you haven't seen them yet. But elsewise, if you're ready to make the jump or you know someone who might want to do something similar, make sure to book a call with us to start your journey to have more control over where your money goes. I hope you enjoyed this video and see you soon.